Hi, and welcome to the last video from GoldCore for 2018. We're having a look back at financial markets throughout the year, and we're asking the question, what just happened? Hi, I'm Dave Russell, and I'm here with Mark O'Byrne and Stephen Flood, and we're looking at financial markets for 2018 and asking the question, what just happened? We sat down this time last year, December 2017, and we discussed what we thought we were going to, what we could expect rather from markets from 2018. Some of those things have been starting to come true. So let's have a look and see what just went on. Mark, if I kind of come to you, we had 2018 has been a bit of a roller coaster year, to put it mildly, across financial markets. What's your take on it?
Yeah, absolutely right. It's a huge roller coaster and very, very volatile. And I actually thought that markets had done better than they have done. It's only when I crunched the numbers in the last few days that I realized that some of what we said at the start of the year, we talked about the everything bubble and how the everything bubble was vulnerable and that a lot of these markets are vulnerable to bursting. And when I look at the numbers now, just in the last few days, I see that many of these markets, they look like they have begun bursting, you know. And if you look at, obviously we look at the financial assets and risk assets, stocks and bonds, and then property, and then we looked a little bit at Bitcoin. So I suppose you start with Bitcoin, that was at about $14,000 back when we did the podcast around this time last year, and it's now whatever it is, $3,500. So it's absolutely collapsed.
It climbed up to nearly $20,000, I think. Was it just after that? And so it kind of dropped right from a height.
Indeed, yeah. Massive falls. I can't remember, did it go to 20,000 before we did the podcast and that had begun to fall, or did it was so volatile and it was up and down, and but it's fallen very sharply as we warned it probably would, you know. But if you look at the stock markets internationally, I think it's fascinating. There's a great table that we have from the Wall Street Journal.com, and it gives the year-to-date performance of stocks around the world, and it's just a column, a sea of red, basically, you know. Wow. And of this, I think it's 53 different stock market indices around the world, and I think 43, 44, 45 of them are in the red, some quite significantly so, you know. There's only a handful that are actually up. There's India is up, New Zealand, Norway, Argentina, Brazil, and Israel. They're the only markets in the stock markets in the world that are up.
And obviously, we're not hearing any of the major indices in that list there as being, you know, none of the U.S. markets seem to be performing in any way.
Well, the U.S. markets are the only markets that have performed, yeah. So that's what's up for the year is the dollar. All emerging market currencies are down. Most currencies are down and have down versus gold, as well as versus the dollar, obviously. But the only things that are performed are basically U.S. stocks. Sorry, not the only things, but the primary assets that perform well are U.S. stocks. But it's particularly, again, the NASDAQ and the tech sector. If you look at the NASDAQ 100, it is up 4.6%. And again, it's very much centered on these FANG stocks, the Facebook, Apple, Netflix, Googles of this world. The actual S&P 500 is down 2% for the year, you know. So, but it's, and you know, when I talk about all these stock markets, obviously there's a lot of exotic stock markets all around the world, but we're talking about big stock markets. The Nikkei is down 10% year to date. The EuroStoxx 50, so the 50 biggest stocks in Europe, are down nearly 12%. The DAX in Germany is down 15%. Shanghai is down 21%. And then good old little old Ireland, our ISEC stock market, you crunched the numbers before the show, Dave, and it's down 21%. So, and that's just that's exactly year to date. So from January 1st last year, if you go from peak to trough, the falls are much more significant, you know. So most assets around the world are down. The things that are up, as I said, are the US dollar, US stocks, particularly the tech stocks. The VIX is up massively, so the volatility index is up by 86%. And it's interesting enough, there's some commodity inflation taking place as well. Natural gas is up 32%, wheat is up 24%, so your bread is going to get more expensive. Oats are up 20%, porridge is getting more expensive, cocoa is up 17%. So there's a bit of commodity inflation kicking in, you know. And then finally, just to sum up, the everything bubble beginning to burst in 2018. Property markets around the world We've long talked about London being an epicenter of a global property bubble. The Australian property markets, Sydney, Melbourne, Perth are falling sharply. The Canadian property markets, Vancouver. Just today, news came out the Canadian Vancouver property markets down, I think, 8.5%. Toronto, Montreal, all these property markets in Canada, Shanghai, Chinese property market, Paris. So it looks like the everything bubble is bursting, as we said it would do at the start of 2018.
Steve, just before I come to you, Mark, there's one thing I just wanted to remind you, because when we sat down last December and talked about it, you actually warned about, there were a lot of people talking about Bitcoin being a potential safe haven asset, and you warned people against that and said, listen, it hasn't weathered any storms, it hasn't been around long enough for anybody to start to call it a safe haven asset. And I just want to say to you, what you said proved very correct and very prescient.
Oh, absolutely, and Steve said it as well, and we've been very consistent. It's an unproven, untested, speculative asset, a speculative currency, and who knows, in time it may become a store of value, as its proponents evangelically claim, but that has very much yet to be seen, and it could go to zero for all we know. I don't think it will. I think it will probably survive, but who knows? And it's a high risk speculation, and the technology is very interesting indeed. But yeah, it should not be seen as a digital gold or as a safe haven in any way, because it's not, and most likely it never will be.
Right.
Did he just steal my big intro there? Was that question for me?
Sorry, Steve.
I think it was.
Right.
but that's okay. That's okay. You're good. Yeah.
Steve, you're taking it then, right? Well, just 2018 as a broad question for you, first of all, what just happened?
Well, before I answer that question, I want to go back to the question you asked me first, which is the Bitcoin. And you're right. Now we did look at it. I think that the thing to look at in any of these emerging markets and these emerging concepts is, who is the market, who's involved in the market. When you look and you ask people what their motivations are for being in that market, that'll give you an idea as to the kind of dynamics that market's going to go through. So with a price fall, you had a lot of weak hands in the cryptos. They sold it aggressively, and there wasn't enough support there, which means it was kind of fleeting weak hand type market, and people are owning it as a speculative asset and not something that they'd bought into fundamentally, that they had suddenly embraced the idea of cryptocurrencies and all of these very, very interesting concepts in terms of sovereignty of one's money and independence and disintermediation and immutability of crypto. And I remember one time, I maybe said it last time, as I spoke to a barber once, and he told me how he very proudly owned some Bitcoin, and I said, "That's great. Do you use it as a currency?" And he goes, "No, I never spend it. I mean, it's only going to go up." And I was like, well, that made all the sense in the world to me at that time. And so it seemed quite obvious that it didn't really have a firm foundation. But I wouldn't count it out. I do think that the concept is still very much in place, and I think the future is going to be very interesting for cryptos. I expect these incumbents to really come out with something in that area in the future. But it's had a hell of a roller coaster. So very interesting times.
And then 2018, just in general, what just happened?
Yeah, I think it's the great deleverage, to be honest. We've had this extraordinary bull market. It hasn't, those who've been looking at markets for many, many years, such as myself and Mark and yourself, will look at this market and say it was very poorly underpinned as well. Many of the participants in the market weren't traditional value hunters. They weren't people who understood the fundamentals. There's an awful lot of what I've termed in the past bad actors. So you had a lot of passive indexers in there, which is kind of, and I don't mean to be mean towards them, but it's kind of dumb money. They're buying something because it's on an index, not because the stock is necessarily fundamentally undervalued. And it means that when the proverbial hits the fan, they also act like weak hands, and those markets will fall. I do think that towards the end, in the last month or two, something very interesting has happened. Many hedge funds who have made their living very successfully, so large hedge funds, timing the markets, seeking opportunity, looking for undervalued stocks, have actually withdrawn from the market. They've kind of thrown the towel in and said, hey, we can't make money in an algorithmic driven trading environment where you have passive indexes just buying relentlessly, overvaluing everything beyond any reasonable means, and then you have systemic traders, computer-based systems coming in there and taking all the small crumbs off the table and pumping in a lot of volatility into the market, and it makes it extremely difficult to get an edge. And so they're actually closing down funds, and some of them are returning monies back to their investors, which is the right thing to do. If you don't think you have an edge, you should absolutely withdraw from the market and see what happens in the future. But I do think that's a very interesting thing. You don't have big proprietary trading desks as in the market as much as before. You have central bankers printing money and buying up stocks mindlessly, and you have passive indexers mindlessly buying up stocks, and we're blind. We don't know what a fair rate of return should be, and the bond markets are similarly infected, and I do think it's an infection where we can't actually understand what the a reasonable yield is on debt, and if we don't know what you should be getting back for a given investment, and we don't know what we should be borrowing what rate we should be borrowing at, it makes it very difficult for investors to actually understand the markets going forward. So I think it's a huge change.
And one of the things that we discussed at the beginning of the year, or last December at least, was continued uncertainty coming into 2018. That really seems to have come true, whether it's Brexit and the uncertainty around Brexit that we had this time last year. 12 months later, we're still in very uncertain territory, Mark, aren't we?
Yeah, no, absolutely, and it's gotten more uncertain, and it's just a saga. And what's happening, obviously in Westminster and in London, it's amazing. Just every single day, every single week, there's new developments. And obviously Theresa May, we had the vote of no confidence there this week, and it's looking more and more like we're going to have this no deal Brexit and hard Brexit, and we just don't know what, as we said continuously, we just don't know what the ramifications of this are. But we do know that it will impact our various economies. It will impact the UK economy, the Irish economy, and the EU economy. And who knows, in the medium and long term, it might be in the UK's interest. It may or may not be, but it's nobody's interest in the short term, because businesses and consumers just don't like uncertainty, and I think it is creating a lot of uncertainty now, a lack of confidence, and people are beginning to pull back, I think, and just getting nervous about the outlook. And I think that's possibly filtering into the property markets in London and in the UK and even in Ireland, and I think we're beginning to hear signal and noise and signal in that regard, So that's set, no doubt, that's set to continue, and it creates real risks, obviously, to currencies, both to sterling itself, and sterling has had a tough year, and to the euro, because it poses a risk to the European Union, as does the Italian situation and what's happening in Italy, and the risk that Italy goes the way of the UK potentially. These are real risks to the EU, and that poses real risk to the euro. And ultimately, we said at the start of the year that gold should do well given these risks, and it actually has done quite well. And so we'll come to that now in a second. It's everyone talks about gold being down, but it's only down in dollars. It's up in euros, it's up in pounds, it's up in most currencies in the world,
And yeah, Steve, I was actually going to ask you that question. I mean, gold has kind of been sideways for most of the year, but it's still proving to play that role as a safe haven asset, because we've seen an awful lot of turmoil in the stock markets, particularly in the last 3 to 6 months, and gold is really holding its own.
Yeah, I mean, it's looking positively bright compared to an awful lot of other laggards out there, and we're seeing quite a lot of interest picking up a lot of what we would term smart money, people who are looking to it for its very fundamental reasons, not necessarily for price performance, but more for safety, return of capital. I mean, just if you join the dots, if you have one of the largest economic blocks in the world, the EU, about to lose one of its most important trading partners in a very ugly divorce, and you're weeks away from that final deadline, and still there is acrimony, there is a horrendous political dislocation, and you realize the integrated nature of our economies. Nobody could look at this situation and have any degree of confidence for the future in terms of our ability to manage these things. And also, they're not even looking at the actual fundamental reasons behind it. Why is it that Britain decided to leave the EU? What is it connected with this recent Yellow Vest protest in Paris and in Belgium? There's been a massive change at the very base level in our economies right throughout the West, where I believe the middle classes have been, their financial system financial state has been eroded and eroded. The cost of living has increased. Their job opportunities and security has been eroded as well, and they're voting accordingly. And so it's a very, very I think uncertain time. If Britain does leave and it's a messy divorce, what happens to our integrated banking system? Will banks seize up again? Will there be bail-ins where people's deposits are confiscated to recapitalize banks? The legislation is in place to make that happen. So we absolutely believe that systemic risk has risen tremendously in the last 12 months. It may not even just be, the story may not be Britain, but it might be some other European country looking to leave soon. It could be Italy with their mountains of debt and wishing that they could leave so they could devalue their currency or their debt, their locally denominated debt. And we don't know how exactly it's going to play out. It's a very, very interesting time, and I think cohesion and the middle classes and political extremism is the kind of the themes for the next 12 months, and that will be represented in our investment marketplaces and in our local economies.
Mark, tell me this, and I'll ask Steve the same question in a moment. The event of 2018, what really sticks out in your mind?
It's hard to know. There's so many. Trump on the Twitter machine again, and the trade wars, and just the crazy stuff happening on that side of things, and then obviously Brexit we alluded to as well. I think that one of the biggest things, and also the most, I think, underestimated and underreported is actually the share price of Deutsche Bank, one of the biggest banks in the world, biggest bank in Germany, one of the biggest banks in Europe. I think it is the biggest bank in Europe. If it's not the biggest, it's one of the biggest, and its share price has fallen to 7 or 8 euros. It's had a massive price fall, and now behind the scenes the German government is looking like they're going to force a merger between this massive German bank, Deutsche Bank, and another massive German bank, Commerzbank. And it shows you that the financial system, the banking system, is much more vulnerable than we've been led to believe. When this massive German bank is under financial pressure, they wouldn't be doing a forced merger unless it was at risk of insolvency, and it creates the risk of a Lehman Brothers, and that's why the German government is jumping in there. And yet it's barely been reported, and Deutsche Bank has a massive derivative book as well, so we have ripple effects throughout with other banks that are exposed to Deutsche Bank, and then indeed in the derivatives market itself. It creates real systemic risk. So I think we're going to see more of that. It's interesting, just this week now, Janet Yellen has come out. Janet Yellen, the ex-Federal Reserve governor, said that there would never be another financial crisis in her lifetime. She said that only a few months ago, and now this week she came out saying that there's a gigantic hole in our financial system and there's going to be another financial crisis, and it's crazy stuff. And then the IMF has come out yesterday, one of the senior, I think it's the one of the most senior guys in IMF, saying that we're on the verge of another financial crisis, and the banking system itself is at risk, and that's what Stephen alluded there before in terms of because the debt levels, ultimately the debt has not gone away. The debt is bigger now than it ever was, and it's the global debt to GDP ratio is heading towards 320%. So it's completely unsustainable, and we're beginning to see that. There's actually one other thing this week that I think is quite important, and Janet Yellen warned about this week, and I think she saw the writing on the wall, because Bloomberg only reported yesterday, US leveraged loan funds, they lost the most amount ever. In the last week, there was a 2.5 billion outflow, the largest on record, as I said, so bigger than the financial crisis, So mutual funds saw 2.5 billion outflow, and then ETFs saw an outflow of 705 million in 1 week. So it's beginning to, the falls we're seeing in the risk assets, in the bonds and the stock markets, is now beginning to feed into the credit market and into the lending market, and that's when things will get interesting again in 2019.
Yeah, so never say never, Janet. Steve, your event for 2018.
I have 3 of them. Okay, so in no particular order. I thought one that really caught my eye was the announcement in March that President Xi in China would be president for life. Which I thought it was a news story that just kind of came and went with a whimper, and I just looked at that and I said, so many people are now going to be ruled by a man, whether he be good, bad, or whatever, forever, and they've given up on that that essential concept of kind of renewal within any kind of leadership structure, which is proven over the centuries to be very, very important. So I think that's a really important one for the future. And I think one that caught my eye as well was when Apple stock hit $1 trillion in market capitalization for the first time ever, in nominal terms. I know in price adjusted terms, I think there may have been another $1 trillion company in the past, but recently it hit it, and it's down. That was in October, and it's down at down 21% since then. So the biggest company in the world hit an all-time high, and now it's down 21%. It's now a $790 million company. And the other one I thought, which I think is going to be one for the future, because I'm a big believer in the European project as a post-World War II stabilization initiative. I'm a huge believer in it, economic union and integration. But it's becoming a federal project now, which we never voted for, so I have major problems with that. And I think the announcement of the retirement of Angela Merkel, who has been a very important stabilizing factor for Europe and has given great leadership for a group of countries who aren't necessarily in union on lockstep on a lot of different things. I think her retirement is interesting. Whether what will happen there for the future, will they have another leader in place of her mettle? I don't know, but I do think it's going to be a big part of the story of Europe for the future. I think so. They've got China, Europe, and you got the United States in those three different events.
Okay. And Steve, actually, just stay with you for a sec. 2018 has been a very busy year for GoldCore. You launched a couple of new products and services there. Do you want to talk about that for a second?
Yeah, I mean, we've been very, very busy here. As you know, we specialize in segregated allocated bullion, and we've taken that one step further with the announcement of our direct access gold program. If you haven't come across it, anybody listening should search for that, and they'll see a page on our website there that describes it.
We'll put a link to it in the show notes here as well.
Yeah, it's a great innovation. It's the first time a precious metals investment firm has ever gone so far to protect the interests of a client. And we look at this because, in our view, the future, with those uncertainties we've talked about, the spot price of gold and the you might say the proxy price of gold, such as the price that the ETFs trade at and digital gold providers trade at. I think there's going to be a massive difference between gold for physical delivery and proxy gold in the future. So you'll have two spot prices of gold, and I think it's going to be very important that if you're owning it, you need to have it in a physical state, in a safe jurisdiction, in a non-bank vault, and you need to have it on your balance sheet and nobody else's, and you need to be able to direct that precious metal to any market that you wish to do so. And that's what we've achieved with Direct Access Gold. It allows the client to present themselves directly at the vault, circumventing ourselves, the dealer in that case, and allow the customer to take receipt physically of their bullion at the vault whenever they wish, and it's never been available before through a dealer, where you also have liquidity to market, and you can buy and sell within your account and maintain the metal in chain of integrity. So it's a huge innovation, and we're really proud of it, and our clients are really excited about it.
Cool. And Mark as well, you've had a lot of coverage in the media about new vault that you guys are operating in Ireland. Do you want to talk about that one?
Yeah, so we've launched institutional gold storage in Ireland for the first time. So it allows investors and pension funds, companies to own gold in these ultra secure vaults in Dublin. And yeah, as you said, it got picked up Reuters, Bloomberg, CNBC got picked up in media internationally. And yeah, we're quite excited about it because Ireland it's a safe jurisdiction. We're doing it in conjunction with some of the leading storage providers in the world. So in conjunction with Loomis International, and it's it's just great. It's something that we've long wanted to do, and it took us a long while to get it live, but it's great. So people can own gold as an investment, lump sum investments, pensions, in these ultra secure vaults. And we're getting business obviously in Ireland because people want to have gold closer to home, given the various risks in the world, geopolitical risks and risks in it with Brexit and in the European Union. But also, there's investors internationally who see Ireland as an interesting jurisdiction, and especially UK investors who want to have gold closer to home. Maybe they don't want to have it in London, but they're worried about Brexit, they're worried about the devaluation of sterling, and Dublin is quite attractive to them as a storage location as well.
Fantastic. Gents, we'll leave it there for today, but I just want to let everybody know that we're actually releasing a special podcast on January 1st, and it's going to be our look forward to 2019, what we're going to expect from 2019 across financial markets, with a particular interest, obviously, in precious metals. When I'm going to be joined again by Mark and by Steve. But for now, as this is our last video of 2018, we want to wish everybody a happy Christmas and a very prosperous new year. So thanks, Mark. Thanks, Steve.
Thanks, David. Happy Christmas, everybody.
Thanks, David. Have a good Christmas, everyone. Bye.